In this learning objective, we discuss the implications of the academic evidence on the success of the momentum investment strategy for traditional technical analysis. Now, it's important to start by noting that momentum in the academic sense is different from what we would traditionally think of being technical analysis, because most academic research studies of momentum look at cross-sectional momentum. As you'll recall, cross-sectional momentum is where we rank stocks based on their past performance, and we buy those stocks that have performed relatively well over the past intermediate period, and we sell those stocks that have performed relatively poorly. However, given the emergence of some evidence in the academic literature of time series momentum, this would appear to provide some scientific justification for technical analysis. Therefore, technical analysis can be seen as a form of momentum-based trading, but as I said, particularly related to time series momentum. Technical analysis involves the forecasting of asset returns using historical prices, but also using volume data and other measures that try to capture supply and demand in market prices. So when we look at the relative merits of technical analysis, what we might see is that there may be some merit, given research that shows that time series momentum strategies do appear to generate abnormal returns. But the key caveat is that most academic studies don't include market frictions like transaction costs. And one of the big problems with technical analysis is that often it requires frequent flipping, frequent buying and selling, which can increase transaction costs and also increase exposure to taxes. So the basic principle behind technical analysis is that prices is purely determined by the interaction of supply and demand, as opposed to fundamental factors. Now, while those fundamentals might overlay the supply and demand decisions that are made by investors, what we find is that there are both rational and irrational forces that govern investors' decisions, whether they want to buy or sell particular stocks. Therefore, what we might find is that stock prices move in trends which persist for some period of time because those trends are related to trends in investors' views on stocks and trends with respect to supply and demand. So basically the idea of technical analysis is that you can pick up a trend in prices and hence potentially earn abnormal returns if you can identify factors that result in persistent shifts in demand and supply of a particular stock. So the argument regarding technical analysis is one that's been around for a long time. We can look back 80 years for one particular argument, as we've seen here. This is written by John McGee on technical analysis, but also the work of Robert Shiller, for which he won the Nobel Prize, argues a similar point. And that point is, if stock prices alone were governed by changes in fundamental values, we would not see the degree of volatility of prices in terms of what we actually experience. So if we look at the quote we see on the screen here, what we've got here is the argument that back in the 1930s, one share of US steel was worth $261 in the early fall of 1929, and then only a couple of years later had decreased to just 10% of that value to $22 by June 1932. 5 years later, the price was back up to $126, and then a year later, back down to $38. So the argument here is that surely the fundamentals of US Steel, this large company, can't change such that the fundamental value of the firm went from $261 down to 1/10 of its value, back up to a 500% increase, and then back down to about 25% of the initial value, all across the period of approximately a decade or slightly less. So this argument of these significant fluctuations in prices suggests that there might be other factors other than simply just intrinsic value that's resulting in these changes in prices. And hence, the fact that there are these other forces means that maybe technical analysis that can identify those particular forces potentially could be able to be used to generate abnormal returns. So what are some of the signals that are used? Well, the signals that people look at is seeking to identify particular ways to identify structural changes in the supply or the demand of stocks. Some of these include, first of all, market breadth. So market breadth is basically a measure of the sentiment within a particular market that's measured by the total number of stocks in market which have advanced in value versus those that have declined. So where we've got a broader market, that is where you've got more stocks increasing in value relatively to those decreasing in value, it means that demand across the market is strong, and we expect to see a positive continuation of returns or a positive price return pattern into the future. Whereas where we see the opposite, it means that maybe market forces are being driven by supply, hence we might see a negative trend in prices. Volume indicators are also used, whereby some traders believe that higher volume of traded of particular stocks or particular assets implies higher demand for those stocks. So arguably, volume might also be able to be used in order to come up with predictable patterns of returns. And finally is the idea of support and resistance lines. And the idea of this particular technical signal is that investors, and this is partly because of behavioural biases, tend to think and trade around round numbers. Okay, so a round number might be a share price of, say, $30. And also we might have algorithmic trading, whereby the algorithms are programmed to trade around particular round numbers. And hence what we find is that we have these support and resistance lines, whereby share prices tend to bounce within a range of round numbers. And once the price falls outside that range, you then find that either the support or resistance line has been broken. So then you see a trend that's created once those bounds have been broken, and you see a price continuation in that direction. Let's give an example of support and resistance lines, because here on the screen I've shown the share price of BHP shares for the 12 months from October 2013 to September 2014. And what's really noteworthy here, it's really clear that the share price seemed to appear to trade between pretty clear bounds of round numbers $35 and $40. So every time the price got down to around $35, it tended to bounce back up again. Similarly though, when it got up near $40, it decreased again. But in October 2014, that support line, this line down the bottom here, was actually broken. Okay, so the support line was broken. And what did we subsequently see? Well, once that support line was broken, so we then saw the emergence of a trend. Okay, and that's what is argued in terms of support and resistance lines, that the price will move within that range, but then once it's broken, it will then trend for a period until a new range is established. Equally, if it pushes through the resistance line at the top here, we might also see an upward trend across time. Potentially the one technical analysis signal that's got the most justification and the most academic evidence behind it is the use of moving averages. A moving average is quite a simple strategy that is effectively an application of time series momentum. And it's a strategy whereby you look at the current price relative to the average price over the last n days. And n is often a value somewhere between 50 or 200. And the reason we tend to use between 50 to 200 days is that approximately corresponds with the intermediate time period of 3 to 12 months that we look at with respect to momentum strategies. So we say if there's approximately 20 trading months in a year, in 3 months there's 60 trading days, and in 12 months there's 240 trading days. So using 50 to 200 day historic prices to come up with this strategy kind of aligns with what we see with momentum. So what do we say with respect to a moving average strategy? Well, when the current price is above the moving average, or the average price over the last n days, and for the sake of this example, let's say we're using a 50-day moving average. So if the current price is above the average from the last 50 days, then we would buy that stock. The reason being, if the current price is above the average from the past, it implies the price is on an upward trend, and if we're believing in price continuations, we're believing that that trend is going to continue. Whereas when the price is below its moving average from, say, the last 50 days, we would sell that stock. Now, quite often we actually see the most commonly used moving average strategy is 200 days. The reason being is because the longer the period that you use to form your historic moving average, the less trading you tend to find, the less frequently that the signal tends to change from a buy to a sell. So although you might be sacrificing some granularity of information by looking at a longer historic window, there's a key benefit in that you're able to reduce transaction costs. Let's look at a quick example of a moving average strategy based on Hewlett-Packard shares. So what we can see here is that we've got the share price for Hewlett-Packard, and we've got the moving average. So in this particular case, the blue line is going to be the moving average because it's the smooth line, and the black line is the share price. So we can see here at point B, okay, point B, the share price has moved below the moving average. And because the share price has moved below the moving average, that's a signal to sell. So we're selling at this point B here, and look what subsequently happened. Quite a big price drop. We then buy when the price moves above the moving average, which happened at A. So we sold at B, bought back at A, and we can see we've made a gain because over the period we were short this stock, it actually decreased in value. We then bought the stock at A, and then look what happened. There was a positive price trend across time. So in this simple example, sample of one, we can see there might be some evidence that the moving average strategies have some benefits. In our workshops, we'll actually be looking at an application of moving average strategies. So just to finish off this particular module and this particular learning objective, let's look at some tips for momentum trading. So basically, you need to have views about the underlying source of momentum profits and trade accordingly. That is, if you're a momentum trader, that should be because it aligns with your investment philosophy, and you should have a belief of market failings that accords with some of the behavioural explanations that have been put forward to explain why momentum generates abnormal returns across time. It's important with momentum that there are a wide range of different ways momentum strategies can be implemented, so often it's important to backtest your strategy, paying particular attention to volatility, success rates, and also transaction costs. Looking at things like technical analysis signals. Technical analysis may have some benefit based on the idea of time series momentum, but the issue is often they incur significant transaction costs, and that's one big negative of using technical analysis as opposed to some of the other momentum strategies we looked at. The success of a momentum strategy, though, does depend on a lot of factors, and often in particular can be sensitive to how long you hold the investment. For example, we looked earlier in a previous video, we showed that if you hold your portfolio for more than 12 months, that is, you rebalance at a frequency that is longer than 12 months, you'll more than likely find that prices tend to subsequently revert, which means that your returns will be lower.